right. Hey, everybody. How you doing? It's Uncle Bruce here. We're back for the final hour of trading today. I thought today's show I would do it in front of the old whiteboard, and we'd go into a couple of examples on option possibilities, a couple of trades you might want to consider doing, answer some questions on any trades you're thinking of doing or you're wondering about whether they're a good idea or not on the option side. And let's see what happens. The whiteboard is great for laying it all out rather than me just telling you verbally what's happening. Welcome to the channel, and welcome to the final hour of trading for the day. It's good to have you here. I'm going to just double check that we're good on the connection here. Yep, we're fine. And I'm going to make sure that we take care of our members. This is a chat. It's open for members only, and so we're going to go into that area. Here we go, members only. There we have it, save, and we're good to go. Thank you for being members of this channel, and fire away with your questions. That would be terrific. Alrighty, there we go, and there we are back to here, and we're on it. Okay, guys, nice to see you here. Right now, the Dow is up 32 points. It's turned the corner from being in the red all day long. The stock only went positive in the last, in the last half an hour or so. It was not looking good. Finally, the Dow made the turn. It had been down as low as 35,245. It's now 35,546. So this is a 300-point climb from the low point today to where we are now. To be up 31 points. The S&P is up 1.8, and NASDAQ is still down 55, although I think NASDAQ was down over 100 at least. Oil still down $1.07 a barrel. No help for oil today of any significance. It was down $2 a barrel this morning when I last talked to you. Still down $1 on the day. $67 a barrel is where we're at. On some of our favorites right now, we've got stocks we're watching closely. Robinhood down 207. SoFi down 58 cents to 14.41. GameStop holding a gain of $1.89 to 164.42. ATIP is up 2 cents. AMC up 2.15 at 35.62. Matterport got as low today as 13.87, just around 10.45. It's now 10.30. It's come back 43 cents from the low. Still down, however, 61 cents on the day on 1.7 million shares. Quiet day today. 23andMe is down 36 cents to 7.24 after hitting a low of 7.01. So it's returned 23 cents of the losses to be down still 36 cents on the day. Fifth Wall down 14, has been flatlining at 12.50 all day. Vector Acquisition 10.20 right now, down 42 cents. Navsite, which will become Spire Global, is now holding 74-cent gain at 9.97. So this stock is it broke the $10 barrier this morning in the first 20 minutes of the trading. We got the 10.15 a share, then it backed off back to about the 9.50 range or so, and then it came back on to the 9.80, 9.90 range, and now here we are at 9.97, threatening to go through $10 yet again on 393,000 shares. That's all there is. That there's no trading on this stock of any significance. It doesn't take much to pop this market. Good sign? Yeah, very good sign. Well, we'll see how this NSH wants to take care of us going forward. And then Sixtra down 14 cents to 9.28. It's been just under the break-even line most of the day today. IBM up 27 cents, still breaking our hearts at 143.45. The Dow up 39 right now. Microsoft up 45 cents. Apple up $1.63. Tesla still down $32 today because the National Transportation Safety Review Board are going to look into the driving systems of all Tesla self-drive modes. So they're going to do an investigative thing, and that's going to take months and months and months and months and months and months. Today is a headline. Tomorrow we'll all forget about it. We'll hear updates months from now. In the meantime, Teslas will just keep on selling. People will keep on buying them because they love them. And 11 accidents out of how many millions of miles driven and how many millions of days collectively the cars have driven. The statistics are so minute that there's not a lot to investigate here. But investigate they must, investigate they will, and more power to them. If they protect people, fine. Bed Bath & Beyond up 3 cents. BlackBerry down 14. Royal Caribbean down only 38 cents, now coming back to 78.51. And those are the most of the stocks that we're following at this point. So there you have it, folks. Welcome back to the afternoon show. See what's going on here. I was asked this morning whether it would be a good idea to consider writing a GameStop call option for this Friday. Should if you hold any stock in GameStop, should you sell any GameStop call options right now? If so, which call option would you write? How much would you get? Is it worth your while? What do you think about the risk factor? Bang, bang, bang. On and on we go. So I thought I would take a quick peek here at GameStop. The stock right now, the shares right now are trading at 164.22. Here we go. That's where they're trading at right now. And you can write a call option for this Friday if you want to. Of course, if you own 100 shares or more, or you own a long-term call that you bought that's in the money, you can write a call against it. To give you an idea, you can sell or write a call option on GameStop for this Friday, say a 165. To give you an idea, a 165, which is just out of the money, obviously, you would get right now about $5.35 a share in premium. I can learn to write, the 5 instead of the 3 first. Here we go, $5.35 or $535 in cash would come your way as a credit into your account immediately if you were to write this contract. Now, the gamble you are taking is that, of course, if the shares stay under 165, the entire premium of $5.35 will end up in your account. You'll keep all that cash. Thank you very much. I love this country. Even if the shares go to 163 on Friday afternoon, these contracts will be worth $3 in book value. They'll have very little time value left. You can buy them back for less than you sold them for and keep the change. Thank you very much. If the shares, of course, are trading at 160, 61, 62 range, even on Wednesday or Thursday, they will not be trading at 535. They will be at 4-ish, 350-ish. If it's Friday afternoon and the stock is trading at 162 instead of 164, these are worth about $225 a piece. You can score a nice little $300 gain, assuming you want to take the risk of writing 165s that are right at the money. If you want to go a little further out, how about a 170? Let's go a little further up. You can write a $170 call, and this one won't bring you as much premium. It'll pay you about what do we got here? About 345. Let's call it 350. About 350 a contract, approximately, depending on if you put the offer in properly. Right now, the market is 330 to 360. I'd offer one of these at 355 or 350, and see if I would then be the cheapest seller of this contract. You'd only get $350 in premium, which doesn't sound like a lot, but that's $350 for 5 days of your time. That's $70 a day, every day, for the next 5 days. And that's assuming the stock stays at $170 or less for the rest of the week. Now, we know what GameStop can do. We know GameStop can go up $10, down $10 in 15 minutes. We know all that. However, today, the stock hasn't done anything like that at all. It's had ranges, but nothing like we've been used to in the past. The thing, too, about this particular option, let me just double check something here. Here we go, 159 for the low, 169 for the high today on your GameStop. Here's the thing about this contract, though. If you are wrong and the stock goes higher and it goes up to the 168 neighborhood, it doesn't matter. This contract is still out of the money. And so by Thursday afternoon, if the stock's at 168, even though it's gone up $4 odd a share, these will be worth about $2 a piece. If it's Friday morning, these will be about 175. If it's Friday around lunchtime or halfway through the day, these will be about $1 if the stock's at 168. If the stock, however, backs off, say it goes up today to tomorrow, so say to 168, 170, and then on Wednesday, Thursday, it backs off back to 160. Just an intraday low. You know how it is. It jumps up and down. The 160 low on this contract around Wednesday or Thursday of this week, or even Friday, these will be down to $1 in a moment, in a heartbeat. You can then buy them back for 1/3 of what you sold them for, scoop the $250 in your pocket and say thank you very much. On the other hand, you can do nothing. You don't have to do anything. The stock doesn't break 170 the entire week. You keep all $350 for yourself. If the shares do close at 171, well, you're getting paid $170 for your contract if you're getting exercised. Plus, you got the $350 up front. You're actually selling for $73.50. Monday morning, what are you going to do? you're going to buy your stock back on the marketplace. You'll probably buy it back for 170 to 171 again. And you sold it at 173.50, buy it back at 171, and then look at maybe writing a call contract for next Friday that might be exercisable at 175, 180. You can do that. For some of you who want a little more premium, you want a little more money for your stock, and you're willing to give it a little more time, why don't you consider writing a contract for the next Friday? These contracts here, let me just bracket this here. These were expiring this Friday. They were expiring this Friday, August the 20th. Okay, that's expiry. Now we're gonna talk about expiring August 27th. That's the next Friday. Okay, so let's take a look at those. If you want to write August 27th contracts for a little more dinero, a 165 contract, sell a call, whether it's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, doesn't matter. But if you want to sell one call for expiry the next week, you're going to get about $9 a share. So you're going to get $900. So $900 is coming in as a credit, just like up here, into your account. So you have to wait, instead of waiting 5 days, you have to wait a total of 10. So you're at the market, you're at the money, you're getting 174 if you get exercised, obviously. If they buy you out at 165, you're getting 174. Now, it's theoretically possible that you could get bought out with the stock, say, trading at 170 bucks. The stock could be 170 bucks and you get taken out. What do you care? You just got paid $174 because you've already got the $9 they gave you. So what? You turn around, buy it back at 170 and write 180s. Thank you for the upside. On the other hand, if they go to 175 and then you get taken out with the 165 exercise, well, you're getting 174, which is $1 less than the market. But even so, you take the money, you wait, watch the stock fluctuate, see it back off down to the 174, 173 range, jump back in, buy it back, and here we go. Bob's your uncle. The other contract, this 170, if you wanted to write this contract, sorry about the lousy writing, but you want to write this contract here, you're going to bring in for next week, Friday, about $725 or so, ballpark. So that's $725 premium. And I think that's a smarter move. I think that's a much smarter move. Bringing in $725 on a $170 call option, I think it's a smarter way to go. Again, you're taking yourself out. You're willing to be taken out at 177.25 with the stock trading at 164 right now. I mean, theoretically, you don't have any GameStop whatsoever. You don't own a single share. You could waltz into the market right now using a margin account, and you could buy with 50% margin 100 shares of GameStop. It'll cost you $8,200 in cash. So you drop $8,200 into your brokerage account, you buy 100 shares of GameStop on margin, you turn around and write a contract for next week, Friday expiry at 170, and you'll haul in $725 against your debit balance, which means you're going to take your $8,200 balance down to $7,500 balance, approximately. And you're offering the stock for $170. You're just paid $164 for it. So you're getting the 170. That's not quite a $6 gain. You're already getting the $7 gain. You're getting a $13 return on a $116 or $1,600 investment, $16,000 investment, and your actual capital outlay was $8,200. So to put out $8,200 and to score $13 on $8,200, that's a nice 15-16% return for next Friday if you get taken out. If you don't get taken out, the stock goes all the way up to $169.99 and stops dead in its tracks next week, Friday night. You don't care. You're up $6 a share anyway because they've gone up about $6. And this is zero. You keep this. So you're up on paper almost $6 a share, and you're up in cash $725. And guess what you do at that point? At the next week, Monday, you're looking at what we're doing right now. You're thinking about writing a call contract for a week Monday, about $6-7 ahead of the market to try to haul in about $7-something in cash. And you keep doing it until they take you out. If they do take you out, again, if the shares went up to $169.99 on Friday, you won't be writing 170s next week. You'll be writing 180s. you'll be looking at it because you're going to pull the string on the stock and just back off and back off. Not a bad move. If you want to go further out, the money just gets juicier and juicier. You want to write a contract for, say, expiry September the 3rd. See if I can make this work here. September 3rd expiry. Sorry, I'm doing this on purpose so you don't see this glare up here. That's why I'm doing it. You sell a call for 165 or 170. I'll do these again. Keep the same price every time. The 165 call will bring you in about 13 something dollars, 13 maybe 13.50. That'll bring you $1,300 credit. Or if you sell the 170s, you'll bring in about $11, $11.25 roughly, looks like. So you'll bring in $1,125 in cash right there, writing these contracts right here for September the 3rd. Look, come up with $8,200, buy 100 shares of this stuff for buy 100 shares for $8,200 on margin, and then immediately write an $1,100 credit contract, so that you've got $1,100 against your $8,200 already. If you get taken out, you're getting roughly $6 gain again. 6 plus 11 is $17 gain on an $8,200 investment. $1,700 against $8,200. 20% on your money for 2.5 weeks. That is an option. Those are options that you can consider at all times. You can go much further out, as you know. You can go much higher up, as you know, on the contracts. Totally up to you. But for those of you who are looking for quick money every week, you're looking for cash, an idea is to sell a 170 contract for this Friday. Maybe you'll do that tonight, towards the end of the day today, if the stock hangs around here. Right now it's 163.75. Or maybe the shares tomorrow morning, they pop up a little bit to 166. Maybe they go up to 167. You might decide, you know what, I'm going to write a contract for this Friday, but I'm not writing the 170s now. I'm going to write the 175s. What if you have 500 shares of GameStop? You could write a contract today, which expires at 170. Tomorrow, the stock goes up a few bucks. You can write one more contract, 175. Stock goes up $3, $4 on Wednesday again. It's just a little run is happening here. Write one contract at 180. If it tops out and the stock starts to come back a little bit because it's had a bit of a move, let all three contracts expire, or let the first one expire out of the money. The second one might expire at the money. The third one might be slightly in the money. All depends. If you've written 170s, 175s, and 180s. It all depends on the market. You'll buy it. You'll buy one. You'll let one expire because it's valueless. You'll take all the money. One will expire right around the money, so you might buy it back for 25 cents to 50 cents a contract to just close out the position. The last contract might be worth $1.50, might be worth $2.50, it might be worth $5. It all depends on the strike price and the stock price here. But if you sold the contract for $3.50, and even if you have to buy it back for $6, you lose $2.50 on this contract. That's true. But on the 100 shares that you wrote against, the stock went up over 170. You're actually up $78 in value on your stock. So you don't mind losing a couple $100 on this contract. Your stock went up $8. Nice week, right? These are strategies that you can employ. Anyway, there you go, folks. There's some ideas here about how to do it. You don't have to use a margin account if you don't want to. Obviously, you can do it all with cash. If you can afford to buy the stock without any margin, great. But I wanted to show you a margin idea where you can use half the cash to buy 100 GameStop, immediately bring in a whack of money like this one right here, $1,125 against an $8,200 debit that you have in your account. You're only owing now $7,100 against this 100 share position. So it's $16,400 of the stock, and you owe $7,100 against it, courtesy of an option buyer who bought this September 3rd expiry contract for $1,125. All you got to do is now wait until this date here to either let it die worthless, or between now and this date, what you might do is you might just buy it back. Keep this in mind too. The stock's 164.22 today. All right. The contract that expires this Friday at 170 is a 350 contract. The contract that expires next Friday, this 170, is worth 725. The increase in value is increased time. Look at this one here. It's also more valuable because of time. So in theory, if next week at this point in time of the week, the stock is 164.22 in this neighborhood, what are the odds that this contract 1125 will be trading at 725? They're very high, because a week from now this contract has a week less to live. This one already died this Friday, by the way. This one is the next one to go. This one is the next one to go. 2 weeks from now, this contract should be trading at 350 if the stock's at 164.22. You get that realization going and you go, oh, okay, wait a minute. Yeah, all right, I see what you're saying, Bruce. You're telling me that if I took 350 away from 1125 here, that's 775. I will make $775 profit on this contract if the stock is sitting at 164 2 weeks from now. No matter what it does in the meantime, it can go up and down and gyrate everywhere, but if it's around 164 2 weeks from now, the odds are that this contract will be trading at 350. And in theory, you could buy it back here, and you could then turn around and rewrite a new 3-week out contract for 1125 again, and you're locking in a 775 profit every 2 weeks on 100 shares. You're doing that twice a month. You're bringing in about $1,550 a month. And if you do that 12 times a year, 12 months a year, you're bringing in $18,000 a year on an investment of $16,400 or $8,200 on margin. In other words, the margin balance that you took on to buy these 100 shares will disappear very quickly if you keep pulling in $700 every 2 weeks on this thing. Within 10, 11 weeks, you've paid off your debit. You own the stock without any debt against it whatsoever. Again, food for thought. Those of you with 500 shares, this is where you guys can become self-employed, because if you have 500 shares and you can pull in even $350 for 4 days and scoop this, if you let this expire worthless, in theory, you're bringing $1,750 this week. If you're bringing in 775, doing the strategy where you write this contract only to buy it back at this price or less, because keep in mind, tomorrow this will not be 350. This will be about a $3 contract. On Wednesday, this will be about a 250 contract, assuming the stock is around here, which means this 1125 becomes a 225 or a 250 contract 2 weeks or so from now if the stock is sitting at this level or a little lower. You're locking in $800 per contract times 5 contracts. That's $4,000 in profit to you for 2 weeks of your time. That's $2,000 a week. It's $100,000 a year. Are you making $100,000 a year at your job? Just kind of asking. You might want to consider being self-employed. How can you be self-employed with 500 contracts? Well, you either buy 500 shares for 80 grand or you margin 500 shares at $40,000. Have you got $40,000 lying around? Can you get house equity of $40,000 to pick up 500 shares on margin? Say you have $50,000, a little extra than just the minimum. You can start writing 5 of these, $5,500 coming in every 2 weeks gross against your $50,000 gross position. That's 10% of your capital coming in every 2 weeks on a gross level. If you let it expire, then you have to wait 3 weeks for the turnaround. If, however, you do the buyback, where you buy this contract back as it fades out in the last week or so and rewrite new ones, you're holding in $7, $8 every 2 weeks times 5 contracts. There you go. There's something for you to think about. All right. Thank you, everybody. Nice to see you. Here we go. Hey, Uncle Bruce, I sold GameStop covered call, $180 covered call at $369 this morning. It's now $152. Should I buy it back? What's wrong with that transaction? Nothing. That's a $2.10 gain on a trade. Pretty well done. Let me take a look at it now. See if I'm not sure if I'm up to speed on the new quote or not, but see if I can refresh my page here. The stock right now is at 163.86. Is that correct? 163.86. Yes, it's 163.86. So your contract right now, the 180 is sitting at about 138 to 143. Last at 142. So you buy it back for 142. I love this idea. You're scoring about a $2.20 gain on a contract, $220 for today if you did one. You make $200, $200 something like that every day, 5 days a week. That's $1,000 a week. That's $50,000 a year. That's pretty good money. Not a bad strategy, because the stock is still up $1.33, and yet the contract has already backed off, because obviously the stock reached 169 when you probably pulled the trigger. Nice little deal. Not a bad deal. If you wait now until the end of the week, you will only make $1.38 or $1.40 more. That's all you can make for the next 4 days. You've made two something now. You've made two 50 now. Take this off the table. Yeah, buy it back, lock it in, say thank you very much, and now wait. And what are you waiting for? What you're waiting for is the stock either has a rally the rest of the day today. If it doesn't, wait till tomorrow morning. See if the stock has a midday rally tomorrow, pops up $3, $4, $5. Write a 180 for Friday. Again, this contract that's 140 might pop up to 250, 275, $3. Pop it off again, sell it, and then cross your arms. Watch the stock fluctuate. It gives you 150, 250 on a buyback. Buy it back again. Do that all week long. All week long, the market is giving it to you for free. Yeah, there's ways to play this game, and you can make money in a market that isn't doing a lot right now. I mean, notice our shares on GameStop. They're not doing a lot right now, yet you're holders of this stock. You should be paid to hold this. And even if you can make a buck or two or $3 or $4 a week on your stock, you should be taking the money off the table. These option players are the gamblers. They're the guys who are playing the clock. They're hoping for the stock to rocket to infinity in a 1 or 2 or 3 day time frame. You are the ones saying, I'll tell you what, I'll write a contract and watch it deteriorate dramatically, and I'll take the game that way while I hold the stock anyway. Not a bad strategy. Anyway, thoughts. Those are just thoughts from me. Thank you, everybody. What's going on here? Last week, I sold 2 GameStop covered calls for the 27th of August, $180 stock. I'm happy to take a continuous income from my shares while I wait for a potential squeeze that might never happen. There you go. Excellent job. Excellent move. I totally agree with that move. I wanted to talk to you about something else, about another strategy that you could employ on another one of our stocks. Let me just get this off the sheet here. Get this off the board. Here we go. Take a look here. Okay. I want to talk about SoFi and options on SoFi. I'm a believer that the shares and the company will do very well. I'm just one of those guys that thinks that the company will do quite nicely. And what I'm thinking about here is taking advantage of a scenario where I want to earn some money on this stock. Whether I own it or not is irrelevant. So let me start this off here by saying, first of all, writing up here, SoFi. The shares right now are $14.35. Here we are with less than, how much time to go? About a half an hour to go in the day. We're at $14.35. You notice how the glare just totally blocks that off there? You see it now, $14.35. All right, so the stock's at $14.35. Here's what I was thinking. I would like to be paid to possibly buy this stock. It's kind of what I'm thinking about doing. So what I want to do is I want to write or sell a put contract on SoFi for September 3rd expiry. All right, and I will receive by selling it approximately $125 a contract or share, $125. Now, this is just one contract. You can do this with 5 contracts, 10 contracts, whatever kind of capital you want to risk, how much capital you have. But by doing this, by selling a put contract against SoFi for September the 3rd for $125, I am saying to the market, I'm willing to buy SoFi for $13.75. Because what could happen, theoretically, is someone could sell me 100 shares of SoFi for every contract I write. They could sell me a stock at it's a $15 exercise on the contract. This is a $15 contract. They could sell me 100 shares for $15 a piece. They're already giving me $1.25 for the privilege. So they're saying to me, I'll give you $125 if you let me sell you stock at $15 until September the 3rd on your SoFi. The shares are at $14.35. I'm prepared to pay $13.75, but you got to give me $125 right now. I get the money in my account. If I do 10 of these, I'm prepared to pay $15,000 to buy 1,000 shares, but I've already been given $1,250 up front. I need to come up with $13,750. If I have a margin account, I need to come up with half of that. I need to come up with about $6,700 out of my pocket to complete the obligation. Now, if the broker knows you have enough asset access and assets in your account, they will let you write 1 or 10 or whatever number of these you want to write. If the shares do what I think they can do, that is, go higher, please, because it's SoFi, please. I don't want you to sit at the $15 a share, $14 a share anymore. If SoFi shares were to run up to 16, 16.50, or even stay at $15 or higher, I will not get exercised at $15. In theory, though, I could get exercised tomorrow morning. In theory, it's highly unlikely, but by the time September the 3rd rolls around, if we're trading at $14.35 a share and I don't do anything, I will get assigned. On the other hand, I have options in my hand. I have choices, I should say, choices in my hand. And that is, I can do nothing and I can defy them. I can make me buy the shares from them. So I'm now paying $13.75. Or if the shares are trading at $14.35 on the 3rd of September, okay, $14.35 on the 3rd of September, they are in the money 65 cents. The difference between $14.35 and $15 is 65 cents. So each contract is worth $65 in book value. The likelihood is I can probably buy these back on the last day that they have to live at about 75 cents a pop. I got $125 when I sold them. I get to keep the $50. So in reality, I make a $50 profit per contract, not buying SoFi shares, even though I'm offering to. I'm offering to buy them for $15 a piece until September the 3rd, but you have to pay me $125 up front to do so. The time depreciation with the stock sitting at $14.35, but that's where they still are in September. I still am left with a $50 credit in my account per contract after I buy these back. If I've written 10 of these things, I cleared $500. Thank you very much. I like making $500 not to buy something. On the other hand, if the shares do go up and they go up to $15.01 or higher, no one's going to sell me stock at $15. I get to keep all $125 per contract in my account for not buying SoFi. There's a strategy right there. Now, the same strategy on another stock we dearly love is something known as IBM. And I want to show you how we can play that little game over there. Okay, let me get this out of the way. IBM. The stock right now in IBM is $143.47. $143.47 a share right now. Okay, there we go. And I can do an option contract on IBM for as long or as short as I want. Let me take a look at September calls for fun. I'm doing this on the fly. I have not rehearsed this. This is just being done right off the cuff. For example, I could write a put contract. This would be a 142 put contract. All right, here it is, 142 contract. One put. I'm going to sell it, and I'm going to receive, and this is for the date. This is for September the 3rd. All right, September 3rd, 142, one put, sell. I'm going to bring in about $1.50 or so, roughly, a share, which is $150. There you go. So I could sell or write a put contract against IBM where I am pledging to buy the stock for $142 until September the 3rd, and I'll be paid upfront $150, $1.50 a share. If I'm getting $1.50 a share, I'm really committing $140.50 to buy a stock trading at $143.47. A stock that we know is going to split, a stock that we know, a company that's generating higher earnings every quarter, a stock that not this past quarter, but the quarter before did a dividend raise. we think that the uptrend looks good on IBM. But I purposely wrote an out of the money put. This stock isn't even in the money; it's out of the money. It's out of the money by $1.47. Now, you know and I know this stock's a heartbreaker. This stock can just defy logic. The Dow can go up 150 points, and IBM can go down $1. I mean, it can really upset us. On the other hand, IBM might reach this 145 level, 150 level in the next few weeks as we get closer and closer and closer to the split that's coming, because IBM is going to be splitting into two divisions, and you're going to end up with two different stocks. If that moves this market up to the 150, 160 range, these contracts are worthless. That no one will ever sell a stock for $142. So I can keep the $150. Now, I can theoretically buy IBM stock and go long and then write contracts against it, but I got to come up with $143 to buy it. That's $14,300. Even on margin, I got to come up with $7,100. That's pretty expensive. On the other hand, if I have a margin account, my broker might say to me, you need to have enough margin ability to buy these shares at 142. So I need $7,100 in the house in order for you to take in this deal. But for $7,100, you're going to make $150 not to buy this stuff until September the 3rd. These are conservative transactions that you can consider doing on something like an IBM. Okay. All righty. Let's see what else is going on here. Any comments and questions? Let's go. Can you explain that weird situation where you could get assigned prematurely due to a dividend payment falling on an opportunistic date? You're talking about the longest of long shots that almost never happens. I'm just not going to go there. It is. I don't want to not answer the question. It is just something that is not going to happen to 99.99% of us, and I want to keep the show more relevant for everybody else. Let's see here. What else have we got? Any other comments that I need to? Here we go. Mirko, I bought it back for 134. That's 235 in a day, and I did it with 4 contracts. Very nice. I was thinking about September 3 strike 185 next. So there you go. You did 4 contracts, netted you out 235. So you cleared $900 odd today. That's a beautiful trade. That's as good as it gets. That is a perfect intraday move on a scenario where you write the contract this morning because the stock had an uptick. You wrote them, and in the afternoon they had a slump. You bought the contracts back. You locked in your gain, and now you're just looking for your next deal. Beautiful, beautifully done. Keep your eye open for the next opportunity. That is nice. There you have it. Hi, Uncle Bruce. I want to employ the same strategy with SoFi. What option strategy would you suggest for someone with 4,000 shares? Are you thinking about the same strategy about writing intraday calls? Is that what you're thinking of doing? I mean, it can be done. You are obviously going to have to be very much on top of your market at all times. But you probably are if you have 4,000 shares. I mean, 4,000 shares of SoFi means you can write theoretically 40 contracts if there's enough liquidity on the contract you're trying to write. Now you might try it with 10 and then maybe then another 10 and another 10. You might have to work it off a bit here and there. The catch though is you need to get a premium. You need to get a premium that'll pay you enough to make it worth your while. If you're trying to write a contract that expires this Friday on SoFi, August the 20th, the stock's at $14.33. Trying to write a $15 call contract, you'll only bring in 22 cents a share. That's $22 a contract times 40 contracts. That's $880. And theoretically, you're putting up your stock at $15 a share for $880. Might be a little too risky because the shares have had a dramatic drop off from the 1750 range just last week down to this level here. And they seem to be kind of leveling off right now. During the day here all day long, they're kind of holding off here. Maybe they can bounce back into the 15-50 range, and you may not want to write right now. You may want to look at writing a further out contract where you can get a better premium, and maybe you can play it that way. But the problem here is even going out, gee whiz, there's nothing here. I mean, September the 3rd contracts for SoFi, even if you wrote at 15, you're only getting 65 cents a share. It is 4%. I mean, you're selling at $15.65 if you got taken out. But boy, that's $1.30, $1.30 away from here. Do you really want to play that game? We're down 66 cents this afternoon. Tomorrow morning we could open 60 cents on the first trade of the day, and all of a sudden you're within earshot of possibly getting bought out. I don't see the potential here with SoFi at this point in time, enough premiums. You may have to write contracts that are way out there. You might have to look at literally writing the contracts I've been telling people to buy, which are the Januaries. If you want to sell January 15s, which people have been picking up, you can pick off or get paid about 265 a contract, and getting 265 cents a share on your 1432 stock, that's a hefty premium. There's no question about it. But you're now limiting yourself to 1760 on the takeout, assuming you don't buy them back if the stock goes up, right? The other problem, of course, is you're stuck now until January 2022, and between September, October, November, and December, the next 4 months, a lot can happen, including that bank charter, including other announcements and or other acquisitions. I mean, it's just too much there. That's why I'm more of a fan of literally buying these things than writing them right now, because I think writing them with a $14 price handle is just too much of a risk. That's where I'm coming from. All right. Let's see what else is going on here. What is rolling over a call option contract? How do you do it? By selling? How do you do it? By selling to close and buying to open? Keep looking for the rollover trade option, and I don't see it. Well, rolling over a contract. Basically, what we're talking about here, for example, let me go with another issue completely. Alrighty. Let me take a peek here at some of our favorites. Just taking a look at our quotes as well, by the way. Just curious, how are we doing right now? The market right now is up 56 on the Dow. We've got 18 minutes to go in the day here. We've got a 450 gain on S&P, 52-point drop on NASDAQ, a 96% drop on oil right now. Okay, so rolling over a contract. Rolling over a contract can be done whether you're long or short. It can be done either way. All right. So if you're playing right now on let's say you've got GameStop shares, and you wrote a call on GameStop. Here's an example. I guess what I'll say right here. Okay, this is again the stock GameStop. Here we go. GME. It's trading right now at 163.26. All right. If you're writing a call option for this Friday to expire, all right, you're selling a call, and it's an August 20 call, and you're writing. Let's say you wrote a 170. I'm just going to pick a. This is just pure random off the cuff. A 170 call, and you sell it right now for about $285 a share. Okay, that is $285. That's a credit into your account for this Friday if the stock stays under 170. All right. And an hour from now, you change your mind. You feel that, oh, gee, I think there's an announcement coming out of the company. I read an article about it, and I think something's happening. I want to offer the stock on a contract at a higher price than 170. I don't want to be taken out possibly at 170. I feel I'm too close to the money right now. So I would like to write maybe a $200 contract instead. What should I do? Well, first thing you do is you're going to buy this one back. And let's assume it's at $285 because you're doing this in 15 minutes from now and nothing's changed. You're going to turn around then and sell another contract. Again, you're assuming you're going to sell another call, but now you're going to sell a call perhaps further out. So you'll look at something like a September contract. Let me pop up the option chain. Here we go. What about here? Here we go. Let's say you're going to sell a September 10 call contract. You're buying back the August 20 that dies this Friday. You're going to write a September 10, but you're going to go with a $200 exercise price. So if you're going to get taken out, you're going to get taken out at a higher level. You're going to get about $850 right here for this one. All right. So even though this contract is further away from the money, $30 further out, you're getting more money on the contract. You're going to get a credit of $850. Now you just paid back. You sold this for $285. You bought it back for $285. You're even, and now you're writing this one. This is a rollover. You're rolling this one into this one, and that's all that is. We call it a rollover. Some trading platforms allow you to enter rollover trades in their option trading platforms. Others, they just say, just enter your orders singly. So buy back this contract if you want out of it, and then turn around and sell this one. So when you created this contract, this first one, the August the 20th, this was a sell to open. It was an opening transaction, but you had to sell because you were writing it. Then you bought it back, so you did a buy to close. Then you created this one right here. That was a sell to open. And now your account is short one contract. You sold it, bought it, and you sold this one. You're short this contract. You have a credit in your account of $850 cash. You got an option exercise premium of $200, the exercise price, but you're committing your stock until September the 3rd, or September the 10th, excuse me, to the option owner. So you're willing to say to the option owner, you can have this stock until September the 10th. You can buy it off me for $200 a share. Thank you for giving me $850 already, which means you're selling for $208.50 total. All right. So you're no longer selling for $170 plus the $285, $170, $285. You're committing your stock for $208.50, but until September the 10th. Of course, you can at any time buy back this contract. You can buy to close this contract anytime you want. If what you thought was going to happen to the stock didn't happen to the stock, it's like been a week or two going by. We're now into late August here, towards the 27th, 28th, 29th. This contract is slipping in value because if the stock is still around here or is only sitting at 166 or 170 a share, you're $30 out of the money. This contract is bleeding big time. It might be down to $3.50 in value. You can buy it back anytime you want when you see fit. So if you buy it back for $350, you score a $500 gain on your investment or your right, the opening transaction, and you still own your stock. No one took it away from you. No one came and got it. Hopefully, the shares have gone up in value between now and September the 10th. But even so, if they go to 175 or 180 or 185, they're still well under the $200 exercise price. These contracts will die worthless on the 10th of September if the stock does not break $200 a share. So that is the pressure that the option buyer has that you don't. You're the writer. You're sitting there going, yeah, I got this little stopwatch here, and this baby's running. The countdown is on, man. The clock is in my favor, and you're the one taking the risk that something big has to happen in a shorter period of time. And as each day comes by, and we get closer and closer to September the 10th, and the stock's up here at 163, 165, 170, and there's only 5 days to go before these contracts expire, this contract will have zero value. It will be worthless. It'll be worth a dime, 15 cents. You'll have long ago likely bought it back. Just to give you an idea right now, a $200 call option on GameStop that dies this Friday, the 20th of August, this contract as a 200, right now you can buy it back for about 55 cents. So it's worth $55 right now with 4 or 5 days to go. I mean, in theory, you could write it. You could write that contract right now at $200 for 4 days and get $55. That's how much you'll get. If you want to write a 190, you'll get about 80 cents. That's all it's worth. But it is, substantially out of the money right now. Time is a killer when it comes to option players. They get murdered by this thing. All right, there you go. Yes. What about AMC? I'm still holding some of those, about 1,000 shares. Yeah, sure. You can write 10 contracts on AMC all day long. You can write contracts that expire maybe this Friday if you want, or next Friday, or a month from now. You want to bring in a big, fat, juicy premium. and you feel that there's still upside on the stock to maybe the $45, $55, $60 level, you can write $45, $50, $55 call options that are good for 3 or 4 or 5 months. You can bring in some serious money doing AMC contracts. Absolutely. This is exactly doable. No question about it. Thanks for the tip. You got it, everybody. Let's see. What else? That's correct. I read that as a call buyer. You also never exercise your in-the-money calls. You sell them before expiration, before it's time, value is lost, and reduce the risk. That's correct. There's no point in exercising call options if they have a premium like these have. Even if the shares went to 170 this afternoon, why would you exercise this contract? This contract, if the stock went to 170, went up $7, this contract will go up to about $6.50. Just sell it for $6.50 and take your profit. Thank you very much. That's what you're here for. Let's see. So my question is more a very basic question to understand the market. Who is then actually exercising those calls after I sell them? Or after they get sold again? After all, they do expire in the money. Thanks. Well, what happens here is you might write this contract right here. You write this contract for this Friday, okay? You may find, you will never know, but it is possible that this particular contract that you created this afternoon at $2.85 a pop might change hands between now and Friday morning 15, 20 times, because the stock is always moving up and down. The value of this contract is moving up and down. The time squeeze is on. It's all relative to the stock price and this exercise price. This contract is going one direction right now for the next 4 days, down. Why? Because as long as the stock is under 170, this contract is heading to zero. It's heading to zero. Everybody knows it. Even the people buying it from you, they know that if the stock does not go up, this is a nothing burger. They lose all $285. You keep it. But it's possible that the shares might go to 166 tomorrow morning on the opening, and that these go to 350. The buyer who bought them from you sells them to somebody else in the open market. It's irrelevant to you because you're short one contract. You really don't care. Stock was to 166. You're going, hey, my stock's up almost $3 today, and that contract I sold is up a little bit too. But it doesn't matter because come Wednesday, stock's back to 163 again, still out of the money right here. If the stock backs off on Wednesday, this contract is trading at $1.50, from 350 to $1.50, and it may have turned over 3 times. From 350 to 325 to $3 to $2. It's trading all the time with all the other contracts that are expiring this Friday. By the end of the day, Friday, you don't care if the stock is under 170 a share. Here, this contract has a zero value. No one exercises anything. The contracts expire worthless. If your shares, however, are 171, 172, 173, they're higher than $170. You have a choice to make on Friday during the day as we're coming into expiry. You can either buy your calls back for whatever they're trading at and get out from under the obligation of selling out your stock at 170, or you do nothing and let them take the stock from you for $170. The shares are trading at 170.50. They're in the money, okay? But the first person that bought your contract at 285, they're not making any money. That contract is only worth 50 cents because the stock's at 170.50. However, whoever does own contracts at the end might well exercise them to get their 50-cent profit, because they can buy from you at 170 and sell in the market at 170.50 and get their 50 cents. The preferred method to finish this off, to flatten out all option trades, is that in the last day of trading, that people who wrote their contracts, who are in the money now, 170.50, you would buy your contract back for 50, 55 cents, maybe 60 cents, and you just buy it back. You'll lock in a gain of $230, $35 per contract. You made a profit. Thank you very much. Congratulations. But you didn't make the full profit because it did close over, or is indicating to close over, 170. But if it's sitting at 169.50, this contract is going to be trading at 5 to 15 cents in the last hour of the day, and in the last minutes it'll be trading at a nickel, and you don't have to buy them back at all. If the stock's at 169.50, these will die worthless. No one will exercise your stock. You're under no obligation to deliver your paper. On Monday morning, you can write a brand new contract if you'd like to do so, or think about it. at whatever price you want to write one at. Hope that's helping you guys. Let's see what's going on. Let's see what's going on here. It's all math. It's all math. There you go. We're now coming into 5 minutes before the close. We're up 94 on the Dow. It's having a fine day. Considering how the Dow opened this morning to be at up 95 on the day, that's quite the turnaround. S&P is up 9.85. NASDAQ is down 37 points. We've got oil down 95 cents a barrel. Stocks were following. Robinhood not having a good day, down 3.56 a share to 47.07. SoFi at 14.28, down 72 cents, unfortunately. Low of the day, 14.18, not having a strong close with 4 minutes to go. GameStop is up 72 cents to 163.24. ATIP up 2.5 cents to 4.17. AMC holding a gain, up 2.25 to 35.72. Matterport down 77 cents to 14.14. 23andMe down 34 cents to 7.26. Fifth Wall Acquisition down 11 cents to 12.55. Vector Acquisition down 43, not having a good day today either, at 10.19 a share. Nafsite Holdings, which is now known as Spire Global, up 71 cents today. It is the winner, up 9.94. Of the SPACs we follow, this is the winner today. Smart rally to 9.94. Volume on Navsite, 468,000 shares. This is beautiful. You as a Navsite shareholder, you've got to be smiling ear to ear about how this has performed today in this market. This is really, really good stuff. This should start trading as Spire either tomorrow or the day after. We're waiting for final announcement. Cyxtera down 27 cents to 9.15 a share. Vanek Vector's down $1.18. Home Depot up 3.38. IBM up 45 cents today. Dow is up 104 points. Microsoft up $1.88. Apple up $1.89. Tesla down $31. Bed Bath & Beyond down 37 cents. BlackBerry down 21. Royal Caribbean down 34 cents. Norwegian down 41. And Carnival down 3 cents. Amazon, big turnaround today. It was as low as $3,211. It is now $32.97. It has come back $86 from its sell-off this morning at 10:30 this morning. This is a tremendous turnaround. It's up $3.58 on the day with an $86 gain from the low this morning. That's very impressive. On Facebook, up $3.45. It dropped in the morning, came back on. Google, same thing. It was as low as $27.23. It's now $27.76. It's up about $56 from its low. It's up $8.19 on the day. A serious power-up move. And this is why the Nasdaq now is showing a loss of only 34 points on the day. It was down quite a bit more than that at one point on the day. So the markets have had a power-up turnaround on the big boards, the Nasdaq, S&P, and the Dow. Unfortunately, what we're following on our favorites. We're not getting the big move up here, from what I can tell you. SoFi still down 72 cents. GameStop holding an 85-cent gain. ATIP holding 2 cents. AMC definitely holding 2.29. Matterport down 73 cents. 23andMe down 34. FWAA down 11. Vector down 44. And only Navsite is up 73, with Cyxtera down 23 cents. We have a minute and a half to go, and then the day is done over here. And this is our final few moments before the markets shut down for the day. Alrighty, let's see. Any more? Apple calls are doing well today. You betcha. I love the Apple shares, as you know. Love the long-term upside of this company. And if you can buy contracts that are out into January, February, March, April next year, you can get them just out of the money or at the money or even in the money if you can afford that. Pick up Apple contracts and enjoy the ride. I'm very pleased to see how it's doing there. Let's go. Class T's are laughing out loud. Well, this is what we do on our classes live Saturdays and Sundays, and I've got 10 classes in the can now. 8 are available for viewing on the website. 2 more will be up and running in the next day or so, maybe later tonight and tomorrow. We'll get classes 9 and 10 up, where we talk about all kinds of option strategies right here on stocks you follow that you're watching, and you can figure out how to make some money depending on just how aggressive you are, how conservative you are, what kind of capital you have, what kind of risk tolerance you want to go with. Absolutely. All kinds of factors to consider, and that's why I put so much time and effort into explaining it to you. This is not a simple A or B solution business. There's a million ways to go on this. Anyway, there you have it, kids. We're coming into the end of the day. I think we're just about done. 106-point gain on the Dow, 11-point gain on S&P, 31-point drop on NASDAQ. We had a tremendous turnaround on the markets overall, especially on the large caps, which sets up nicely for tomorrow, perhaps. There may be follow-through momentum. I would say that this close tonight in New York will bode well in Asia overnight and in Europe tomorrow morning, which could lead to more momentum our direction. So we'll see how the markets want to play this whole thing. 163.99 on GameStop. Final closing price after hours, 166. I love it. I love it that it shows that. Don't know whether to believe it or not. Now it's showing 163.93. So we'll see what's going on here. Thank you, everybody. Richard, hey, thank you for that comment. Love what you do. Keep us calm and patient, and keep making us smarter and wiser. Good luck to all. Well, there you have it. 163.99 on the GameStop final close. Again, I congratulate all of you out there who do trade weekly contracts or monthlies. Lots to consider, lots to think about. As I say, with GameStop, you can take the short way, where you write a contract that expires this Friday, or you can take the longer route and write a contract that expires, say, several weeks from now. I mean, this isn't a long time. I mean, today is the 16th of September. We're talking, 3 weeks, 4 weeks. These contracts expired 3+ weeks to bring in $850 100. This is serious money. You have 500 shares of GameStop. You're bringing in $4,250 between now and September the 10th. That's your money to do with as you wish. And if you get taken out, you're going to get taken out at $200, $37 higher than this per share times 500 shares. That's a lot of money. That kind of investment, you can make a living off of that. Actually, it's kind of funny how you don't need $1 million to be self-employed if you play your cards right. This is a conservative strategy. Holding stock like this to write these contracts with this kind of money, this is conservative. This is not risky behavior. You're selling a call well into the money, so you're getting a nice little gain on your investment. Plus this as cash right up front. I think this is a smart way to go. One smart thing to consider. All right, there you have it. Thank you, everybody, for hanging out with me today. I appreciate this. Hope you didn't mind today's session in front of the whiteboard. I've been standing on my feet the whole time, and I'm going to shut this show down because I'm tired. I hope you enjoyed it. If you did, please give the show a thumbs up. So we've had 205 of them so far, and I appreciate it. If you're able to throw us any more thumbs ups while you're here, that would be terrific. If you like these kinds of sessions, let me know that you do, and we'll keep them coming. This is what we do on our classes every day or every weekend, Saturdays and Sundays. We've been doing this kind of presentation, and it's going well. Jennifer is the moderator of comments for those who are here live, and it goes very well. It's very engaging. I stop in the middle of the presentation, listen to questions, and then I solve the problem that people are coming up with, or they're not quite getting it. I explain it in another basic way if I can, in plain English. We'll do this again more often, and I hope you like it. But in the meantime, I want you to have a great day today. Have a great night. I'll be back on the air on Traveling with Bruce at 7 o'clock for sponsor members for 1 hour. And then at 8 o'clock, the big show on Traveling with Bruce, where we're going to talk cruise ship news, travel news tonight at 8 o'clock Eastern Time. Everybody is welcome, and I invite you to come in. And thanks, all of you members, for renewing your membership today. Those of you who signed up March the 16th on day one. There's still a bunch of you here. I haven't lost all of you yet. It's awesome. Thank you for renewing your membership and sticking around with this channel and with Auntie Jen and I. We do appreciate it. Have a great evening. If I don't see you on the other channel later today, I will see you here tomorrow morning, 8:30 Eastern Time, 1 hour before the opening. Let's make some money. Okay, everybody. Have a good night. We'll talk to you later. Bye for now.